Shifting gears a little bit about stocks and index, there's a few questions here. Someone asked, the difference between stock picking and index funds, or stock
Yeah.
picking versus index funds.
This is my favorite subject, right? So give you some background. I worked at a big index provider for the first 6 years of my experience in the industry, and I drank the Kool-Aid. I really do strongly believe in indexing. I do also believe that there's a place for active management. Uh, they You don't want to conflate those things though, because in a broad-based decline in the equity market or any kind of market that you're either actively picking securities or passively relying on the index, in either types of approaches, a broad-based decline in that market is going to impact them. Case in point, in the last cycle, right before this cycle, I was it was working, and the largest investment advisor, the American Funds Growth Fund of America, was the largest mutual fund in the world, right? And in 2009, it was down 40%. Was the S&P? It was down 37.5%. So they beat the market, right, with the index, right? No, you can't eat average performance, even if you're investing in index funds. Yes, there's momentum that it's hard to beat, but you can't eat average performance in a down market. So you want to be careful with one, knowing what types of index funds you're investing in, whether it be equity or fixed income, and the risk involved with investing in that market as a whole. Uh, Stock picking it's kind of hard to do over the long run. But when you look at, say, Mark Cuban, is he stock picking? Right. When he starts a business and he buys a business in the ground floor, he's buying stock, he's buying equity in a firm. So there's segments in the market overall, whether it be small size companies or early size companies or international companies, where information is not available or easily accessible by everyone, where being actively involved in making and picking and choosing investments might work. So I say, and I'll make a long story longer, I would say there's a place for both. Uh, you want to make sure that you know the risk involved. And for example, the fixed income side, I would say that's another place where active management makes sense, right? Because for every dollar in equity, there's $9 in a global market in debt and fixed income. So you have to know what you're doing in that market. It's opaque. You don't know what's there. So uh, that's where active management might work. Active management works in markets where it's hard for you to see. There's less transactions, less price transparency, and a need to do a little more analysis.
Okay. So let's break those things down. I'm going to ask you if you can define in like one sentence the four things that we kind of mentioned: stock picking, index funds, actively managed funds, and passively managed funds. So in kind of like one sentence of each of those, let's start with stock picking. Just what is it, right?
Stock picking is the process of figuring out whether a company is worth more than the current price is indicating. So you're making a decision that Apple's price that you see reflected on your computer screen is wrong. You think that they're worth more, so you're going to be picking that stock with the hopes that it goes up higher on a risk adjusted basis after
Okay.
costs.
Awesome.
An index is going to rank every investment, and this is a market weighted index that I'm describing. That's the most well known, most common one. They'll rank each investment by size and invest in those investments as proportion that they make up over the overall index. So let's say if Microsoft, which is the largest company in the world, represents 2% of the value of all the total sum of the investments that are in the top 500 largest companies in the world of the U.S. stock market, then 2% will be invested in that, and then they'll go down the line with how much is it percentage-wise of Apple make up of the overall marketplace of that particular segment of the market, and down, et cetera, et cetera. So what it does is it says that the prices are going to reflect the best information available. It's not always perfect, but it's the best information available. And we're not going to make a judgment to say that Microsoft is going to be it's going to perform better than Apple. But if the market says that the market value of Microsoft is bigger than Apple, on the margin, most people believe that there's a better chance to be right than wrong. So you're assuming, you're looking at the crowd and having the crowd dictate how much and where value is going to show up, and then hopefully over the long run, you're going to be wrong sometimes, you're going to be right sometimes, but you're not going to be so far away from using the knowledge that's out there available than and underperforming and having the risk to underperform the overall market.
So talking on these two before we get to the other definitions, is there one more advantageous or more lucrative and or riskier than the other, stock picking versus index?
Oh, by far, stock picking is going to be more aggressive and more risky than investing in a broad index. So broad index, to say the S&P 500 represents 502. It's kind of a misconception. It's exactly 500. It usually is a little bit more than 500. Let's say you're investing in 502 companies. You're investing in different businesses, maybe even unrelated, a lot of unrelated businesses. And, God forbid something happened and the CEO makes a bonehead tweet. You're not blowing up your entire portfolio if you have all your money, and that just is if you have all your money in that one investment. You have all your money in multiple investments. So it broadens the risk that a company-specific risk has a detrimental impact to your overall performance in your portfolio.
Cool. Makes sense. Let's talk about actively managed funds versus passively managed funds. If you can just define each of those and tell us quickly what the difference is.
So an actively managed fund is a fund that seeks to outperform on a risk-adjusted basis the peers of the group. So let's say you're strictly investing in a large capitalization mutual fund. That fund manager in an actively managed basis is going to compete to outperform all the funds in its peer and also do better than the index. Now, research history has shown that over the long run, 80-90% of the active managers do not beat the market averages. Especially in the large size company space, there are so many analysts, so much information is readily available. That's kind of hard for the active manager to find an edge or find some information that the market doesn't know that they know better. So I would say it's easier or really advantageous to look at indexing in the more efficient markets. I would call that more efficient market than versus say small size markets where fund companies can't hold a certain number of certain size of a particular stock if it's too small. So I mean, there's ways for you to look at different segments of this stock market and pick and choose. And in a long story short, the active managers are trying to beat the market, trying to do better than the average.
And the passive?
And passive is going to seek to do average.
Okay. Now, when you say average, for some people that comes with a negative connotation. Can you just clarify that it may not be?
Average is great. Average is 8 to 10% historically on the S&P 500, right? So every day, people, processes, and products are created by different companies and have a fiduciary risk to do the best that they can for their shareholders. So Microsoft, Apple, that they're trying to make more money out of their resources. And historically, that growth on operating growth has been about 8% in corporate America over the long run. So that's organic growth. And if you own the entire stock market, you're getting that organic growth just from the production of goods and services. So average is not bad, and trend should be your friend. Markets, of course, I gotta say it, obviously are not predictable. They're not guaranteed. They're subject to loss, and the past performance is no guarantee for future pattern of performance. but we use that as an indicator because that's the best information.
Is there, I'm asking you a few more quick questions if you don't mind.
Sure. No,
All
no, go ahead.
right. Is there a safe investment? You know, if someone is very, you know, is not very risk tolerant and wants a safe investment, what conversation do you have with them, or what do you know, instruct them to do?
Safe is a relative term, right? You're exchanging some risk for another. Let's say, for example, if you have all your money in a bank, you're not taking default risk, you're not taking market risk, but you're taking inflation risk, right? The risk is that the overall goods and services are going to increase in price while your money is not getting or growing as much, and there might be a shortfall that you could have the ability to pay your bills in 30, 40, 50 years, right? So you're exchanging, you're figuring out which risks are least important, and I'm narrowing down the areas where we guess. So we will look at your overall situation. This is your risk profile, your risk tolerance. How long do you have until the need for you to spend the money that you're investing? What is your level of understanding and knowledge, so we don't create a portfolio that's overly complicated and that you can stick with and you understand in periods of turmoil. So it's a number of different factors. There's no one defined way to say that one investment is now. Now, with that being said, generally speaking, cash is going to be the least, or cash alternatives or equivalents are going to be the least aggressive. You get a stated percentage every month or every couple weeks that you get to spend. The other choice is debt. Debt is longer term savings. That is money that you give to either governments or corporations, and they pay you a certain amount of interest for that, for lending them that money. That's a little bit more aggressive than cash. And then the higher risk would be your stocks, or what we call equities, where you're getting ownership, you're owner of a company, and as they gain profits, they either pay you in dividends, or you can go ahead and you can resell that business, that share of that business, to someone else who might think it's going to be more valuable in the future.
Okay. So should I, or I mean, any person, when they come to invest or allocate their investments, should they diversify based on certain risks? For example, like, should I have a pie, and for layman's term, not to put all my eggs in one basket, have some investments that are higher risk, but obviously with the higher risk, the higher potential reward, and some that are lower. So if something goes south, not everyone goes to, you know, not everything.
You got it. It absolutely. It's absolutely. So we look at portfolios not as the risk of the individual parts, but the total sum of them together. So yes, you'll have some very aggressive things, and you'll have some safer things. You'll have a Google, and you'll have maybe a AT&T or Verizon. You have some different areas of the market that you're investing in, is along with those debt instruments that give you some safety and stability whenever the markets overall are not moving in the right direction.
Awesome. You alluded to this earlier, but if I can ask again, if someone comes to you or comes to your firm, what can they expect, or what services can you offer to them?
So you're going to get financial planning. You're going to get a review of your current situation, and then a roadmap to get you towards your long-term goals. And it's going to be on a subscription basis, so you're paying per month, or upfront if you want to do quarterly. And then that gives you access to myself through email, through phone calls, and then every month, every 6 months or so, we'll go over that and revise that plan, figure out where you are, and I'll help you with the implementation of different parts of your plan.
Okay.
And then for a highest tier of servicing, we'd also give you an investment portfolio. So I work with 2 of the major brokerages in the world with trillions of dollars in assets. So your assets are held there for your benefit. I don't have access to that. What I do is I have access to picking and choosing which investments are in those accounts. So I'll help you establish an account, whether it be a retirement account or a non-retirement account or any combination of accounts for your household. And then we'll create a portfolio that's appropriate for each of those buckets.
Okay, awesome.
And that comes with ongoing management.
How often should someone revisit their financial plan or strategy?
At least every year, and when there's major life events. So if you had to, unfortunately, like recently, you had to find a new job or you had to retire early, that is a case where even if you had a retirement plan 6 months ago, that's time for you to just kind of dust that off and revisit with your financial planner. So you'll get a financial plan through my firm at least once a year, and then also between those periods of times when there is a major life event that would make sense for us to revise it. And then throughout the year, if you have an investment plan with us, we're looking at that ongoing, and then we're reviewing and going over that every 3 to 6 months per client.
Okay. Specifically to your firm, do the costs of financial planning differ based on someone's capital investment or how much they have to invest?
So it's a flat rate based on the level of sophistication and complexity. So for those who are not requiring a level of turnkey investment management, they're going to be paying a little less than someone who does. So it's 3 tiers of servicing, and I don't want to go into specific details around the pricing, but let's just say that we align the cost to level of engagement that we have with those particular clients.
Understood. And how can someone get in contact with you, or how can they get started in kind of that process with your firm if they choose to?
So they can go to my website. They want to learn more. It's called GammaWealthLLC.com. You can also call me. My number is 443-743-5266. Or you can email me at letsmakeaplan@GammaWealthLLC.com.
Awesome. Thank you so much. Is there any other questions you want me to ask you?
No, that was pretty much it.
Okay, cool. All right, no, that was really good.
Yeah. It was tough.
It was tough. It's okay.
Yeah.
I think I'll pause the recording, but
actually help you develop a budget along with that snapshot of your, and I have all the software and everything. It's cool. It's really, really cool.
that's awesome. Yeah, man, there's a lot of stuff that you can do and you can write about, and I think people would love it. I resumed recording, by the way, just in case we don't miss anything.
Yeah.
Cool. All right. Is there anything that you want to add? Maybe
Yeah, so it's a great opportunity speaking with you, Mina, and I would say if it didn't come across, if you're not aware, you're kind of having questions about what type of firms I work with and the niches. It's really the younger generation as well as those individuals who are working or have worked within the government. So I've had extensive experience with state employees and federal government employees and some of the things that they have to deal with. So whether that's Social Security coordination, whether it's figuring out how to manage your retiree medical benefits, or where your pension is a big part of your retirement plan, and helping you understand when is the appropriate time for you to make that decision to leave. Those are the types of conversations, those are the types of people that I deal with on a daily basis.
Awesome. Well, I'm gonna have some more questions for you, but I'll I won't keep you too long here. But I'll definitely think of some more questions, especially for our young folks just getting into the working world, and how should they kind of manage their money now. I think even from personal experience, with not a lot of education in your 20s, you just make money and you don't know how to manage it well, and then you get in your 30s or whenever it is that you start a family and you think, man, like I wish I could have managed my money a decade ago much better, because I would have been at a much better point right now financially. So, and people just don't know what they don't know, and they don't know what's available out there. So
exactly,
I'm glad.
And they're nervous to ask. I think that's another thing. They're nervous to ask. So give you a little bit of an insight in the industry. you can type in financial planning and you could find a dozen different firms. So you might even see that it's free. So why is that the case? So they are in their estimation thinking that out of 10 people we give a free plan to, maybe 7 or 8 are going to give their firm the opportunity to sell them something, right? And that'll afford the 3 people who are not going to sell them. So there's always this anxiety that there's a hidden agenda when you come into these conversations with these financial professionals.
Mm.
I'm pretty much upfront. Not pretty much. I'm saying I am upfront. You pay for the advice that you're getting. You can keep your money in your 401k. I'm not going to try to get your 401k. If you are within a TSP, if you're a government, you're a Marine, you just got out the Army, you're military. Your thrift savings plan is excellent. Keep your money there. Keep your investments there. Let me help you with financial planning around the other aspects of your life, right? So you can come to the conversation with me at the level of involvement that makes sense with you without there being any hidden agenda. And hey, if you do want to have that traditional relationship at some point in the future, where you want to have the financial planning and the investment management, investment guidance, or advice, recommendations, that's there too. So I think that's the biggest difference between my firm and say another firm.
That's awesome too. And I think one thing I kind of have in mind as you're saying that is also the commitment. I think with a monthly subscription, there's not a huge commitment there. I remember when financial advisors try to talk to me in my early 20s, the conversation just had a lot of commitment, right, on my end, and me not knowing exactly what to do. It was difficult for me to make a commitment in a direction that I didn't even know, much about, right?
And it kind of feels as though you feel almost like obligated to buy something, right? Kind of in a weird way, because they're giving you something for free, and then at the end of the day, this is your friend or someone you care about, right? And they want to make a living, and so they have some idea that but if you only have a hammer, everything's going to look like a nail. And from being on that other side of the table in past lives, right? If I wasn't selling those 7 or 8 people something, then I was going to be out of a job
Right.
at some point, So that's why I created this firm, and I've created this firm for financial planners and advisors as well, because I'm going to be looking to hire people and create more financial planners with this model. I'm here to deliver advice. That's what you pay me for, and there's no other hidden agendas. We're a fee-only fiduciary financial planning firm that's in it to help you achieve your goals, whatever they may be. They're not my goals. They're not my firm's goals. They're your goals. And that's kind of what makes me different.
Last question, just because you mentioned, you want to, bring on financial planners to your firm as your firm grows. What does that look like, or what is the process that those folks would have to go through to become a financial planner? I mean, if they love what you're doing for others and they kind of want to be in the same shoes to do the same for other folks.
Yeah, it's a great industry. I love what I do. And I feel like I'm just like having conversations with people, and it's really enjoying. It's not really work to me in a lot of ways, which is awesome. So I would say look at financial planning firms if you're in college. Financial planning programs at your school. A lot of schools are creating financial planning. For example, Kutztown University, which I graduated from. That's my alma mater. They actually have a financial planning track in their finance department where you're learning these principles and you're moving towards the educational requirements that will allow you to sit for your certified financial planning designation. You can leapfrog the brokerage industry. And I would say 10, 15, 20 years ago, that wasn't possible, but it's a reality. You got to find a firm that has the same values that you have. And, find a mentor. There's our certifiedfinancialplanning.net. That website is a way for you to find someone who might be a mentor or apprentice, or help you with the apprenticeship for going through the program. And then there's regulatory requirements that go involved in testing and that sort of thing. But make a long story short, just speak to someone, find a certified financial planner, ask them about the career choices and options that they're out there, and educate yourself.
Awesome. Thank you for that. Now, I really appreciate all the information, man. I mean, I think those folks who watch this and listen to this will have a lot of takeaways, and hopefully, you know, they'll get in touch with you and start better financial planning and strategizing for themselves in their future. So,
Yeah, I look forward to it.